Hey everybody, welcome to this free edition of our Trader User Group weekly roundup for the trading week ending November 4th, 2022. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is round and round we go, which is what it seems like with the markets here. Let's just dive right in, shall we? Take a look at this past week. It was a very interesting week. Um, all in the red, as you can see. I mean, it didn't start out that way, but it surely ended that way with NASDAQ getting really shellacked the most, down over 5.6%. Dow, S&P, Russell all down solidly in the red for the year. The Dow moved back into official correction territory. S&P moved, they're below 20%, of course, almost 21%. NASDAQ, as you can see, getting shellacked 33% to the downside. The Russell for this year is down 19.91, but off their highs, they're still in a bear market territory. You can also see the PE ratio. For the markets, you can see the forward is 16.92. I think it's going to come down a little bit lower. You can see the real yield in red there is still a negative 2.29%. That tells me the Fed still need more rate hikes to go, with the inflation overtaking the earnings yield. The earnings yield for the S&P is 6.01%, taken by basically the mathematical equation of taking the earnings per share estimate of about 228 divided by the Friday's close gives us an earnings yield of right around 6%. Okay, and then when you subtract from that the inflation rate, that gives us a real negative earnings yield. Current VIX, surprisingly, it was actually down 4.7% for the week. It finished the prior week at 25.75, this week at 24.55, and even though the S&P was down over 3.3%, the VIX came in a little bit. So we're starting to see a little bit of a settle in volatility. That tells me that the markets really are not that fearful right now. There's a little bit of fear in the markets, but the markets still are believing that inflation is going to drop off a cliff next year. The Feds are going to slow down their rate hikes, probably come to a pause sooner rather than later. And markets are just kind of coming in and testing everything. You can see the best performer for the week was energy. Year to date, it's up a whopping 70%. The worst is communication services. It's just having a hell of a year. Year to date, it's down over 40%. So just not very good for the U.S. markets. And what we saw this past week, we got earnings, of course, from Meta, Amazon, Microsoft, all crash and burning. Amazon not doing that well either. A lot of the tech, which where all the money went for the past decade, is slowly being squeezed out, kind of like a lemon and lemonade. They're being squeezed out of those assets and moving into others. Also, after this week, I think the Feds are no longer a friend in the markets. It used to be the Feds would step in, put an artificial put on the markets when they started going down too ugly. They would come out and make some kind of statement that was positive for the markets, with stimulus and other things like that. That's not the case right now. Okay. We saw the stocks again on Friday. We had the job labor department report coming out. They added 261,000 jobs. So there's still a fairly tight labor market. Understand the Feds consider a neutral unemployment rate around 4.25%. And right now the unemployment rate is 3.7%. It's off the 3.5 in September to October, 3.7, but still a long way to go. So I do believe the Feds are very serious when they say they're going to continue with their rate hike move. We did see also this past week the 2-year Treasury note reached a 15-year high of 4.75%. Okay. So what happened in the middle of the week? Well, the FOMC had their statement, and the markets were okay with it. And then the Fed chairman, Jerome Power Ranger Boom Boom Powell, stepped up to the mic, read his statement, and then he started taking questions, and the market sold off. Right. As widely as expected, they did hike the rate 75 basis points. That's 4 months in a row for this. But then it kind of took a hawkish turn when he basically said the Feds have revised their estimate of their terminal rate, which is the highest Fed fund rate in this hiking cycle, up from its September projections. Okay. So he also referred to the pace of hikes not being as important as the terminal rate. So basically what he's saying is we're going to hike and we're going to continue to hike until we see a break in the labor report, and that's kind of where he's coming from, right? He said also that it's quote unquote very premature to consider pausing rates because the markets were on really big on the rate pause concept, but he kind of squashed that pretty quickly. And as a result, by the end of that day, the S&P was down over 2.5%. It moved from 34, 35 points up to 103 points down. So about almost 140 point move during the day. We are seeing a downshift, though, in the anticipated rate hike for their last meeting of this year. They're meeting on the 13th and 14th. The 14th is when Boom Powell does his press conference and they release their policy statement. So right now, the Fed Fund Futures is pricing in a 50 basis point rate hike. All right, and that's after these, as I said, 4 consecutive 75 basis point rate hikes. And right now, the terminal peak rate, according to the Fed Fund Futures, is sitting at about 5 to 5.25%, which is about 25 basis points higher than last month. So that's what's got the market a little bit more in the tizzy. But as you can see it in the numbers on the screen right there, NASDAQ is the one taking the biggest bite with this right here. Okay, so if we come over and we look at the European markets, wow, look at that. Everybody was in the green. They're not dealing with the Fed. They're dealing with their own central banks. But shares in Europe rose for a third week. The central banks over there signaled that they may curb the pace of rate increases. Now, Boom Powell didn't say that, but he kind of emphasized very premature to consider pausing rates, right? So there's a lot of word games going on right now. But over in Europe, it improved investor sentiment. And so 3 weeks in a row, they've been in the green, right? The other thing that helped sentiment was China. There's rumors that China might walk back some of its zero COVID policies. So that's also helping as well. Meanwhile, we're seeing over there year-over-year inflation across the Eurozone accelerated more than expected to 10.7% in October. That was from 9.9% in September, right? Primarily because of higher energy costs, but that's going to stay elevated for a while. In fact, it may go up even more. So they're going to have to stay aggressive with their rate hikes. Maybe not 75 basis point, but clearly 50 basis points, I would assume. They also, their early estimates showed across Eurozone GDP expanded 20 basis points in the third quarter. That's a slowdown from the 80 basis point growth rate recorded in the second quarter. So bigger bets are being placed that Europe is going to have a harder recession than the US, although there's still bets being placed that the US is going to be in a nice recession next year as well. Meanwhile, over further east across the Atlantic, we've got the UK. The Bank of England increased their benchmark rates by 75 basis points to 3%. That's the highest level I've seen their rate since 2008. All of that to contain inflation as well. So all central banks are in a major global rate hike cycle. What's really interesting is the financial press is really not picking up a lot quantitative tightening. Over here in the US, the Feds are quantitative tightening to the tune of a little over 90 billion a month, of about 30 to 35 billion is coming from the mortgage-backed security area. So that's driving interest rates higher for mortgages. I don't think they're going to be able to continue that by the summer of next year, but we'll see. It's reducing liquidity in the bond market, which is much larger than the equity market. We'll see how that plays itself out. I have a feeling that's going to surface either in December or in early next year. We're going to see some issues on quantitative tightening. Okay. And then, of course, if we look over in the Asian markets, you can see the Nikkei, it's up. Their services sector expanded stronger than October, according to some of their PMI data. And minutes from the Bank of Japan's September monetary policy meeting suggested that their economy had picked up activity a little bit. And they're very supportive of their economy. I mean, they've been flat for decades now. So the Bank of Japan is just pouring money into that economy big time. So they're not going anywhere. And then, of course, if we look at the Asian markets, we look at China and Hang Seng. China markets rallied, much like what I said earlier on speculation that the country is preparing to relax its zero COVID approach. I'm not sure how much they're going to relax it, but right now they're on a lockdown, primarily in the Shenzhou area where they're doing the Apple iPhone and others. Neo, I think the electric car maker, and a few others. They've laid off, not laid off, but they've temporarily suspended hundreds and hundreds of thousands of workers where they're going through this 7-day break. But I think China's probably going to have to relax their zero COVID policy shortly. Otherwise, they're just going to drive their economy, continue to drive it deeper into the ditch. And as evidence of that, we're seeing their PMI readings for manufacturing and non-manufacturing in October both missed their forecasts and came in below 50. So it's showing contraction in the Chinese economy. So nothing should be different from that perspective. If we look over in the markets, let me just show you the charts here real quick. Let me just see here. Here we go right here. Let's take a look at the S&P 500 E-mini futures. You'll see here, we ended Friday on a positive note, but for the week it was down, okay? My target was hit in the S&P. My target was between 35 and 3,400. We actually hit 3,502 in the futures market. You can see this rally up here. The rally from the target low was from October 13th right through the end of the month. October 31st is that peak right up here before it started coming down. That was on a Monday. And I had told our members we're going to get a rally in probably the second half of October. And that's kind of where it really started, on October 21st to be exact. And it moved pretty strong through the end of the month. And then on October 31st, we started to pull back. And this whole week was just met by red bars every day except for Friday. Okay. So it's just really not an ugly it was not too ugly, but it was ugly enough to just kind of remind everybody that we're still in a bear market. Right? And one other picture I wanted to show you is, let's go take a look at the weekly chart of this is the cash index, SPX. And if you look at it really closely, that bar here, each bar is a week. That bar right there is a weekly bearish engulfing pattern. We took out the highs of the prior week. We took out the lows of the prior week, although it didn't close on the low of the prior week. But the range was wider, both up and down, and yet volatility fell, right, on the SPX. So generally, when you've got something like that happening, where you've got markets coming down and volatility is falling, that generally tells me that, yeah, there's some fear in the markets, but the markets are not assuming all hell is going to break loose through the end of this year. At least that's the way it's looking. We've got a contango term structure in volatility, and and that's both in the front month and back month, and then going out November and December timeframe, right? So at least from that perspective, that's where we're sitting. And you can see this is the 200-week moving average, not daily, but week. And you can see it's holding us up right here. And just by a second note, you can see right over here. Let me just move it out. You'll see right over here. This was COVID. We blew right through it. That was kind of an overshoot, but it came down and kissed it right there as well. So a 200-week is a good number to use. And you can see right here, it came right down. This is back in 2016. So a 200-week moving average tends to be the bottom of the trough for any big pullback, okay? Now, if we go back out even further, and let me just look at it right here, you can see back in here, back during 08 and 09, that's when we gave it all up and went into a deep bear market. We were down over 55%. And then we regained it. And then really since 2011, we haven't been below it since, except for COVID. So the fact that we're playing with that number right now is a little bit serious, right? We came right down and now we're bouncing up and we're in this symmetrical triangle. We could not get back up above here. If we come back down and test this number and go below it, we're going to take, this was my original range, 35 to 3,400. We're taking it out, folks. I don't think that's going to happen this year. I do believe sometime in the first or second quarter of next year, we will take out these lows and go lower. But then where we end at the end of the year will be higher than that. Okay, so it's going to be a real interesting first half of the year for the markets as we round this out. All right, so I just wanted to kind of give you guys a glimpse as to what I'm seeing here. Now, if we come over here and look at NASDAQ, you can see NASDAQ had a strong day on Friday. but we're hovering right around the lows. And my target was hit right here. We came down, that's about 10,484 right here. And we had a low here this week of 10,636. So it's almost, you could consider a double test. We could get a bullish divergence in the MACD, which would suggest we're going to come back up. Notice we could not, now these are EMAs. This is a 50 EMA on a daily chart, so they are valid, the 50 EMA. We couldn't get over it, couldn't climb up above it. And let me just go back to the S&P for a second, the futures. You can see here we got over the 50 EMA, but we gave it right up in the middle of the week. And as I told our members, this is not good, right? The last time we went over the 50 EMA, we gave it up again here, 2 days over, and we gave it up when we went lower. And then right here, notice this was back in the summer of 2022. We climbed above it for about a month and a half, 2 months. Each one of these white dashed lines represents a 1 week period. And then we gave it back up again, okay? And only once were we able to get above the 200, and that was just for a few days in that big run up in August, right? And as you've heard me say before, until we take that peak out, the markets are still prone to downside action on any rally, right? So this is kind of where we're sitting right now on these markets. The Dow is a lot stronger, of course, because we're seeing, you can see the Dow actually moved over the 200 EMA and then gave it up, but we're well north of the 50. And some of that sector rotation is accounting for the Dow move, because the Dow's got a lot of industrial and energy, as you saw, is up 70% year to date. Industrials are good, materials, commodities, all these kind of things tend to be stronger. And a lot of the big companies in the Dow are those types of industry sectors. So that's why the Dow is doing a lot stronger. Okay. Now, if we come down and we look at volatility, you can see the VIX was actually down 75 basis points or 75 cents on Friday. You can see after these big 2 hikes here, slowly been coming down. Anything, and I've always said, once it gets over 30, it gets very wacky. But once you get below 30, then things tend to calm down. But statistically, as long as the VIX is over 25 and under 30, statistically going 6 months out in time, the S&P is lower rather than higher. Only when it gets below 25 do we see an uplift in S&P going out 6 months from the minute it went below 25. Okay, so that's a little bit about what I'm seeing there in the VIX. And then, of course, if we look at the front month skew, I told you this before. You can see here we're in the green, barely though. That means we're in a contango term structure. And if we look at the back month, this is comparing November and December of all futures. You can see here we're in the green as well. It's still way elevated. And in fact, on Thursday, the 3rd, we actually went into the red briefly and came back down again. So there's still, while it's not official fear, there's, let's just say, a lot of caution. A lot of yellow flags are out. So the markets are very susceptible, like a wound that's slowly healing. It's very sensitive. So if we have any bad mistakes out there, you're going to see this thing roll over very quickly. All right. And if we look at the bond market, it was down 29 ticks, which means interest rates are up. We came right up. It's so common with my checkpoint here. We blow through it, we come up and test it, and we're coming back down, testing the lows here. And this was as a result of Boom Boom Powell being a little bit more hawkish than the markets were expecting. Interest rate rise, if we look at the 10-year rate, you can see here on this 10-year rate, we move right back up again. In fact, my Elliott wave count is suggesting the 10-year rate can move up over 4.5%. And that's when I think it's going to get ugly in the markets. That's when I think the equity markets are going to make new lows. And then the Feds are going to be coming out and doing a pause, not a pivot, but a pause. And then once we hit that, the markets are going to be off to the races, at least initially. Okay. Currency-wise, the dollar got shellacked on Friday, down 2.1. Look at that. All the way down, finding support right around the 50 EMA. It attempted a rally, came down, found some support. Where is it going to go from here? Hard to tell. But it's just I think longer term, the place to be is long the euro, as I've been telling our members. And if we come over and look at the euro, it was up very strong on Friday. And look at it. This is the first time on 10/25, October 25, that it actually cleared the 50 EMA since February this year. Didn't hold it very long, and then it tested it for 1, 2, 3 days, and then came right back up again. If we can hold it and take out this pivot here, meaning going over 101 to the dollar, then I think it's going to have a nice little run, right? That's a little bit about what I'm seeing with the dollar index. And then, of course, the British pound, um, it's up just a little bit, but below the 50 EMA. So we're still in dire straits, guys. It's the orange. I've got an orange flag out on the markets, a red flag out on the NASDAQ and technology, but orange on the general market, and then a green on energy and healthcare materials or industrials. I mean, I think those would be fairly strong, as well as healthcare. If we look at gold, well, gold had a very strong Friday. All right. What can you say? It was up 54 points, ran right up to the 50 EMA and ran into a brick wall. We're coming down. We've tested this 3 times now. My low at 1622. My target was actually 1606. So we ran right up to the 50 EMA. Like currencies in the euro, until we can clear the 50 EMA and find it as support, I'm not willing to play it to the upside. But once that thing hits, it's going to take off. And of course, if we look at silver, um, you can see silver did the same thing, but only with the 200 EMA, right? It faltered over here as well. Silver's got a higher beta than gold. I like silver to the upside, but only when I'm ready. I'm not ready yet on either one of these. And of course, if we look at copper, which is kind of viewed as a global, um, let's say a global thermometer on where the markets are going to go. Look at that big move in copper. That was a huge move on Friday. Huge move. You can see here where it's just struggling to get over the 50 EMA, and it couldn't, and then boom, right here. I would not be surprised to see a retest of the 50 EMA. Just would not be surprised to see it. And then after that retest, possibly running up over the 50 EMA and then back up over the 200. Okay. That would be a good thing globally. Remember, the markets don't wait until the global markets start to improve. They usually start putting in the bottoms well in advance, 4 months, 6 months in advance. And then it gets choppy. We form a long consolidation period, and then it takes off. And then, of course, if you look at energy, let's look at oil. Very strong day in oil. The energy market just went really batshit crazy. Now, the way we're trading energy, you can make money in it fairly easily. Well, let me take out the word easily. It's the highest probability trade you can do in the oil market. All right, and you can see here that we're running slightly higher. And of course, we're not trading direction, but we have a way of trading. It's not condors. I mean, that's not the way you start the trade out. You generally morph into it, but this is the way to take a look at oil. I don't think it's going to get up over 100 near term. I think it's going to stay stuck in a wide range bound area. Okay. Nat gas also had a very strong day as well, right? You can see nat gas moving up. I think it'll find a little bit of a challenge here. Our trade in nat gas, if you're a member, you would have paid for a membership for 10 years because we were short nat gas up here, and it's a great trade. Also over here, we were short nat gas as well. It's a really great trade. But right now, it's not a play. I'm expecting it to eventually roll over, but I don't think it's going to get back up in this area here. Those are gifts that you see every now and then in certain commodities, right? We've seen it in lean hogs. We've seen it in agriculture, in corn and wheat. We've seen it in oil. We've seen it in nat gas, like you see here. They pop up. And when they happen, you definitely want to take advantage of it. They're low-hanging fruit trades where you can make a lot of money. We've seen it in palladium as well. All right, everybody, that's a really quick update on the markets. Members, I will see you this Sunday evening for our weekly market watch. If you're not a member, I highly encourage you to come in and check us out. We're having a lot of fun and making money this year. We're actually well in the green on the market. So, folks, I will see you guys later. Enjoy the football this weekend. And remember, it is daylight savings time for most of you. Pull your watches back before you hit the sack. Saturday night. That would be tonight. Have a good one, everybody. Ciao now.